I'm meeting with Michal Koncar, and for those of you that have watched our other videos, you've seen her before when she talked about the effect of divorce on your home mortgage and some of the things that can affect with if you're trying to sell, if you're going to refinance, if you're trying to take some money out as part of a settlement or a division of equity. But today we're going to talk about the differences and similarities between refinancing your home or taking out a home equity line of credit, if you're going to use that to free up some money for whether that be to pay attorney's fees or to cover other expenses and things like that. So before we go any further though, would you please give them your contact information for anyone that would like to talk to you? Michal is a loan officer, so she can help with loans of all various kinds for various purposes.
My name is Michal, and I work for Elevate Mortgage Group, and my cell phone number is 801-599-0777. You can contact me anytime.
Okay, so before we went on camera, we talked about starting with refinance and some of the things you need to be aware of, and then we'll contrast that with home equity lines.
Okay.
So what are the things people need to be aware of? Because as you know, these are the questions people often feel like asking but are afraid to look foolish, or maybe they're just afraid to talk about the idea. So tell them a little bit about what goes into refinancing your home loan.
So first of all, what I would like to do is take a look at your first mortgage and see perhaps if there is enough equity to do just a regular cash out refinance. So you would still just have the one loan on your property. If there's enough equity in that and interest rates are comparable, that might be a better way for someone to go. Fixed interest rate, 30-year amortization, that might be something that might be a little more affordable for people.
So let's even break it down to even simpler terms. So you're saying that somebody would say, well, right now I have enough equity in my house to qualify to refinance, and I want to take out $50,000 and I qualify. I have 17 years left on my mortgage.
Mm-hmm.
What do you look at, and what would happen then if they qualified? What would that make it a 37-year mortgage, or are you saying, I mean, explain
No,
some of those
we would
simple
just,
steps.
yeah, we would just take the entire loan balance plus the equity that is available to take out and just combine that into one new mortgage.
Okay.
So with rates being so low right now, we're doing a lot of that.
And that's refinance.
Correct.
Okay.
Correct.
And then you talked about home equity line and how that's a species of second mortgage, which
Correct.
is something I had not heard before. So
Yeah.
explain what a second mortgage is, if you'd be so kind.
Okay.
And then what the difference is between the various kinds, including a home equity line.
Okay. So there's two basic types of second mortgages. One is a fixed rate mortgage and one is a home equity line of credit. Home equity lines of credit, or HELOCs as we call them, are variable. They're tied to the prime rate. You can draw from them, pay them back, draw from them, pay them back for a 10-year period typically, and then the balance after that 10 years is then amortized over the next 15.
Meaning you can't take
Draw
out
and right.
redeposit.
The
Okay.
draw stops there.
Interesting.
Yes.
Good thing to know.
Yes.
Why do people take out home equity lines, and what kind of people find that to be the right choice?
The people that I typically work with that want to do home equity loans are people that make commissions, because usually they can put a whole
Because that
chunk
helps
down.
to smooth out the peaks and valleys.
Right,
Okay.
right. And they really are just dependent on the people's situations and their income. A fixed rate mortgage, second, is, I've seen two types before. One is amortized over 30, due in 15, and then just a 15-year. And those are principal and interest payments the same every month. And we have a lot of,
You've got your first mortgage,
yeah.
you have to pay that payment.
Right.
And you've got another mortgage, and you have to pay that as a separate payment. You haven't refinanced and rolled it all into one loan.
Right.
You have two separate
You have two
loans.
payments, and there will be your first mortgage will be listed on your deed, and then you'll have a second mortgage that will be listed as well.
Tell us what you mean by, what did you say, 30 years and then amortized in 30 and payable in 15?
Due in 15.
Due in 15. What does that mean?
It's like a balloon payment. So
Okay.
your monthly payment is low, but you've got to remember that in 15 years, the balance of that is due.
Even though it's a 30-year loan?
It's 30-year amortization due in 15.
Explain what that means to people then.
So you make your payments for 15
we
years.
set you up to make payments for 30 years, but it's actually due in
Due in
15.
15.
Yeah.
Yeah.
Okay. Why do we do that?
They're for very well-educated, financial savvy borrowers.
Okay.
Yeah.
All right.
To me, that's my opinion, obviously. And your home equity loans are just going to be a interest-only payment. So
Until they
you're-
become, until
Right.
you no longer have the right to draw down or
Or pay
replenish or pay back.
Mhm.
And then at that point, what happens? Is it still,
Then let's say you have a home equity loan for $10,000, and you just make interest-only payments for 10 years.
gonna,
After 10 years, you have a $10,000 loan that you need to
And you
start
have to make
making.
principal and interest
interest
payments.
payments, correct.
Got it.
Yeah,
oh,
yeah, so.
thank you very much. Now, there wasn't a whole lot to discuss here, but you sure said a mouthful in the time that we had, because there's a lot of people that just don't know what their options are.
Right.
And so, how long does the process take typically for either a refinance or a home equity? Because sometimes time may be of the essence.
Right. With the new TRID federal laws that came out last October, we're about 30 to 40 days for a typical refinance.
Okay.
Home equity loans and second mortgages, depending on if an appraisal is involved, are a little bit shorter, about 20 days usually.
And do you need an appraisal depending upon the amount of money you're seeking?
It depends on the investor.
Depends on the
Yes.
investor. Okay.
Yes.
So how much risk the lender wants to.
Wants to take,
Yeah.
right,
Yeah.
right.
Thank you very much. This is one of the shorter videos, but still very useful, because I know this is not the first time that people are going to want to know some of the answers to these questions. Michael, for people that would like to contact you to explore any of those possibilities, could you give them your contact information one more time?
You bet. 801-599-0777. Again, my name is Michael with Elevate Mortgage Group, and I'm happy to help. Any questions?
Thanks so much.
Thank you.